Just because Dunkin' Donuts is always crowded doesn't mean you should buy a stock. Not yet. What you got so far is the lead to the story that must be developed. It's not hard to develop a story, it takes only a few hours or so. It is possible to make money in stocks occasionally without doing any research, but why take unnecessary chances? Remember, investing without research is like running through a dynamite factory with the burning matches. You may live, but you're still an idiot. To develop a story, first thing Peter Lynch does is to establish the size of the company relatively to others in the same industry, then place it in one of these 6 general categories: slow growers, stalwarts, fast growers, cyclical, asset play, and turnarounds. Those are 6 categories cover all useful distinction every investor has to make. Slow growers are large mature companies. They expected to grow slightly faster than gross national product. Slow grower used to be a fast grower, but they went as far as they could and eventually gassed. When industry slows down, company lose momentum as well. Slow grower pay generous and regular dividends. They pay dividends because they cannot find more great opportunities to grow faster. You won't find a lot of them in Peter Lynch's portfolio, usually 2 to 3%. Because if the company isn't going anywhere fast, so neither the company stock. Stalwarts companies like Coca-Cola, Hershey's, Colgate, those are multi-billion-dollar hulks. They aren't fast climbers, but they are faster than the slow growers. You should expect from stalwarts 10 to 12% annual growth in earnings. If you own a stock like Coca-Cola and it went up 50% in a year or two, think about selling it. Lynch always keeps some stalwarts in his portfolio because they offer pretty good protection against recession and hard times. Fast growers are Lynch's favorite investments. Those are small, aggressive companies that grow 20 to 25% a year. If you choose wisely, this is the land to 10 to 40 beggars. Fast growers are high-risk investments, particularly those are young and underfinanced enterprises. Underfinanced companies with a lot of headaches usually end up in Chapter 11. Fast growers are high winner in the stock market. Look for one with a good balance sheet and substantial profit. The trick is to find out when they stop growing and how much to pay for the growth. Those upstairs enterprises learn to succeed in one place and then duplicate a winning formula over and over again. The expansion to new markets tends to accelerate earnings and drive stock to new highs. A cyclical company whose sales and profits rise and fall in regular if not predictable fashion. In growth industry, businesses keep expanding, but in cyclical industry, it repeatedly expands and contracts. Autos, airlines, tire companies, steel companies, and chemical companies are all cyclical. They go up when coming out of the recessions. Those stocks rise much faster than stalwarts. This is understandable since people buy more cars and take more flights in prosperous economy. On contrast, cyclical go down much faster in the bad times. You can lose more than 50% of your investment very quickly if you buy cyclical stock in the wrong part of the cycle. Timing is everything in cyclical. You have to be able to detect the early signs of the business is falling or picking up. Turnarounds have been beaten, depressed, and often barely drag themselves into Chapter 11. Those aren't slow growers, though are no growers. They aren't cyclical, they are rebounds. Turnaround companies are potential fatalities. Buy if you can spot the turnaround stock, it can make up losses very quickly. Asset play is a company that sits on something valuable that you know, but Wall Street overlooked. Asset may be as simple as pile of cash, sometimes it's real estate. Asset play companies are usually in metal, oil, newspaper, TV stations, and drug sectors. Those are 6 general categories you should keep in mind when you look for potential stocks to buy. So this is the end, guys. I hope you learned something new and thank you so much for watching.